Here are the top 5 dividend ETFs to own for passive income. Kicking off with number 5 is NOBL. If you invested $10,000 into this ETF 10 years ago, you would have $29,712. Now, this is the ProShares S&P 500 Dividend Aristocrats ETF, and this is a fund that focuses on stocks in the S&P 500 that have raised their dividend every year for the past 25 years. And it invests equally in all of these companies, spreading out your risk, and it rebalances every single quarter to make sure that it stays balanced and meets its goals. It has a 10-year average return of 10% with an expense ratio sitting at 0.35%, which is the highest on this list, a dividend yield of 1.97%, and a 5-year dividend growth of 7.5%. The assets under management sit just under $12 billion. There are 74 total companies in this fund, and the top 10 companies make up about 16.5% of it. Now, these are companies like Clorox, Black & Decker, Aflac, and McDonald's. And if we take a look at the sector breakdown, we can see that industrials, healthcare, consumer defense, basic materials, and financial services make up around 75% of the entire thing. Number 4 on our list is DGRO. This is the iShares Core Dividend Growth ETF. And if you invested $10,000 10 years ago, you would have $32,367. DGRO is a company that focuses on US stocks that have a strong track record of raising their dividend every year for at least the past 5 years. And it focuses on large, medium, and small companies that have a sustainable dividend and they don't overextend their profits. The 10-year return is sitting at 11.9% with an expense ratio of 0.08. The dividend yield is 2.5%, while the growth of that dividend for the past 5 years is over 11%. The assets under management sits at $26 billion, and there are 415 companies in this fund, with the top 10 making up around 27% of the whole thing. And these are companies like JP Morgan Chase, ExxonMobil, Johnson & Johnson, Apple, and Chevron. The sector breakdown is kicked off with financials sitting around 20%, followed by healthcare, technology, industrials, and consumer defense. Number 3 on our list is SCHD. Now, this is the Schwab US Dividend Equity ETF, and $10,000 invested to this 10 years ago would be $32,883. SCHD is a fund that invests in the top 100 US companies with very strong financials and a history of paying a high dividend. It focuses on reliable companies that stand out relative to their peers, and it's often regarded as the king of dividend ETFs. Its 10-year return sits at 11.4% with an expense ratio of just 0.06%. The dividend yield on this is sitting at 3.5% with a dividend growth of over 10% for the past 5 years. The assets under management for the 103 companies in this fund is at $56 billion, and the top 10 make up 41% of the entire thing. These are companies like Lockheed Martin, BlackRock, Coca-Cola, and Home Depot. The top 5 sectors are similar to a lot of funds in this list, starting with financial services and moving on to industrials, technology, consumer defense, and healthcare. Number 2 on our list is VIG. This is the Vanguard Dividend Appreciation ETF, and $10,000 invested into this ETF 10 years ago would now be $33,064. Now, you may have noticed a pattern so far in this list. This is also a fund that focuses on companies that have increasingly and consistently raised their dividends over time. It mirrors an index by holding the same companies with the same proportions, and it focuses on steady growth and reliability. The 10-year return for VIG sits at 11.7% with an expense ratio of 0.06%. The dividend is 1.6% with a dividend growth of just under 7% for the past 5 years. Assets under management is at $93 billion with 344 companies in this fund, and the top 10 making up 30% of the whole portfolio. And these are companies like Apple, Broadcom, Microsoft, JP Morgan Chase, ExxonMobil, and United Healthcare. 80% of the sector breakdown makes up the same groups as before. We have financial services, technology, healthcare, industrials, and consumer defense. The number 1 dividend ETF on this list is SPHQ. Now, this is the Invesco S&P 500 Quality ETF, and it's composed of a group of companies determined to have high quality, which means that they have a lot of revenue and cash flow, so they have a lot of money and they're really good with it. And $10,000 invested into SPHQ 10 years ago would now be $40,681. It has a 10-year average return that beats the S&P 500 at 13.4%, an expense ratio of 0.21%, a dividend of 1.1% with a dividend growth for the past 5 years of 3.5%. Assets under management sit at $9.33 billion with 103 companies in this fund, and the top 10 making up about 44% of the entire thing. These are companies like Johnson & Johnson, Broadcom, MasterCard, Apple, and Visa. Now, SPHQ's sector breakdown is a little bit more heavily weighted in this one. We have 34% in financial services, and then if you add in technology, healthcare, and industrials, those 4 groups make up around 80% of the whole thing. Now, I have a bonus dividend paying ETF here that's not really known for paying out dividends, but I want to see if you can guess what it is based on the descriptions I'm about to give you. It has a 10-year return of 18.4% an expense ratio of 0.2. The dividend yield sits at right around 0.5%, but the dividend growth for the past 5 years is 12%. Assets under management is $323 billion with only 101 companies in the entire thing, and the top 10 companies make up over half of this whole fund. And as we can see from the sector breakdown, technology makes up almost half of the whole thing, followed by communication services and consumer cyclical, making up over 75% of the entire fund in just 3 sectors. And if you invested $10,000 into this ETF 10 years ago, you would have $66,139. And if you haven't guessed it yet, it's the ETF QQQ. Now, I wanted to add that one in there because it's not really known for being a dividend paying ETF like I mentioned before, but its return for the past 10 years has been absolutely insane, and I just couldn't pass up adding it onto this list, especially when you compare it to a lot of the dividend paying ETFs that people love so much. This one would double your money compared to a lot of them. And so if we look at a summary of the 6 funds that I just mentioned, there are a lot of pros and cons to each of them. And honestly, I think any of them could be a really good pick. But I wanted to make this list to at least give you a good starting point for your research if you have never heard of these ETFs before. And the criteria I chose for this list is that the ETFs had to be around for at least the past 10 years. It had to grow a dividend every single year. It could not be overly weighted in a single sector aside from QQQ. And it had to have a low expense ratio of less than 0.5%. Now, why should you choose dividend investing compared to anything else? Well, number one, dividends have a steady income. So you're getting paid every quarter or every month, depending on how often that they pay out. With ETFs specifically, you get a lot of diversification. So you're not just single stock picking, but you get a group of stocks all in one fund. There's potential for growth in the stock itself while they're also paying you the entire time. So it's kind of like a double whammy. And in turn, you get to reinvest those dividends in something called the DRIP method or the dividend reinvestment plan, which just adds to your compounding. And my favorite reason for dividend ETF investing is the lower volatility that it often comes with. And so if you're older or you're closer to retirement or you can't really stomach a lot of volatility in the markets, dividend investing might be a good choice for you because there's less volatility overall. And by the way, some of the websites I use to get all of this data together is dividend.com, Seeking Alpha, Stock Unlock, and Morningstar. Now, I'm not associated with any of these companies or these websites, but I wanted to at least list them in case you were curious about checking out these funds for yourself. Now, if you're new here and you haven't subbed yet, make sure to subscribe and hit notifications so that you don't miss out. I'm going to be releasing a new video every single week. Also, I left some links to my favorite investing books down below. You can check those out on Amazon if you're curious. But that's it for today. We'll see you in the next one. Peace.